Okay, let's dive right into this explainer. Today we're going to uncover the real math and, honestly, the psychology behind the ultimate wealth building debate, real estate versus stocks. We constantly hear these fierce, almost religious arguments that one asset class is just absolutely superior to the other. But what actually happens when we track these two strategies, dollar for dollar, hour for hour, over 2 full decades?
Well, this is the exact dilemma facing our two 28-year-old investors, Ethan and Lucas. They both just hit a massive financial milestone. They each earn about $65,000 a year, and they've both been living well below their means, skipping those expensive vacations, driving older cars. Because of that discipline, they have both managed to save exactly $50,000.
But that is pretty much where their similarities end. Ethan absolutely believes in the power of tangible assets, stuff he can actually physically see and touch. To him, real estate is the proven path. Lucas, he sees things entirely differently. He wants a completely hands-off approach, where his money quietly grows in the background, without demanding a single second of his daily time.
So let's break down exactly what they do with their cash. Ethan takes the plunge. He uses his $50,000 as a 20% down payment on a $250,000 rental home. To finance the rest, he takes out a 30-year mortgage at 7%, which makes his monthly payment right around $1,330. He lands a tenant pretty quickly who pays $1,800 a month in rent. So you subtract that mortgage, and he's clearing $470 every single month. I mean, it almost feels too easy, right?
Meanwhile, Lucas takes a completely different route. He literally just dumps his cash into a broad, total stock market index fund. Since he has a little cash left over after his own living expenses, he sets up an automatic $200 monthly transfer, and then he just closes the app. That's it. No leverage, no weekend spent property hunting, and absolutely zero tenants calling him about a leaky faucet.
And this really beautifully illustrates the emotional contrast between these two paths. In year one, Ethan feels like a true wealth builder. He can actually drive past his investment on the way home from work, look at the physical house, and quietly smile knowing he owns it. Lucas, on the other hand, looks like he's doing absolutely nothing. He just has a brokerage account and a generic confirmation email. One investment feels incredibly real and gets totally validated by his friends, while the other feels completely invisible and, honestly, kind of boring.
Fast forward 3 years, and on the surface, Ethan looks like the undisputed winner here. He's collected roughly $64,800 in rent against $47,880 in mortgage payments. So on paper, that gives him nearly $17,000 in pure positive cash flow. That is a massive early victory.
But watch how quickly that $17,000 just shrinks once you peel back the layers of real, inevitable expenses. The moment you own a rental property, the bills just start arriving. You've got property taxes. You have to account for a good rule of thumb of about 1 month of vacancy every year. Then there's routine maintenance, which usually eats up about 1 to 2% of the property's value annually. You add in the big-ticket repairs, the insurance, and those late-night phone calls and weekend inspections Ethan has to handle to avoid paying a property manager, and suddenly that 17 grand profit realistically drops down to just a few $1,000s. And Ethan, he's exhausted.
Now, despite the hidden costs and the absolute drain on his time, Ethan does have one enormous advantage, and that is leverage. This allows him to control a $250,000 appreciating asset using only 50 grand of his own money. So when that property value climbs, that leverage magnificently multiplies his wealth. It's a really unique power of real estate that stock investors just cannot easily replicate.
Let's move back over to Lucas and see how his portfolio builds over time. Remember, his investment doesn't feel exciting at all. But at an assumed average 10% annual long-term return, his boring strategy hits a huge compounding inflection point by year 7, growing to roughly $120,000. Those first few years barely felt rewarding, but now his investments are generating more growth each year than his actual out-of-pocket contributions. Compounding is quietly changing gears.
Jumping back to Ethan, by year 5, he's no longer this excited novice. He's an experienced landlord. He's had a plumbing emergency, the roof needed replacing, and his property sat totally empty between 3 different tenants. So while his rent has gone up, so have his taxes and his insurance. When all is said and done, he's realizing his actual cash-on-cash return is closer to 3 to 5%. Still, a highly respectable investment for sure, but notice how those massive margins you always hear casually claimed online are getting eaten alive by true expenses. He's just left with a tiny slice of net return.
At the 10-year mark, we hit a truly surprising milestone.
Their net worth is remarkably similar. Ethan has roughly $180,000 in equity, but look at what it took to get there. He's carrying hundreds of thousands in debt, his wealth is tied up in his single physical property in one specific neighborhood, and he has spent hundreds of hours of his actual life managing it. Lucas, meanwhile, sits on a portfolio of about $175,000. He has zero debt, he's highly diversified because he owns tiny pieces of thousands of companies, and it has demanded zero effort.
Okay, another decade passes. It is time for the ultimate showdown to see how these radically different strategies pan out over a full 20-year horizon. Which of our two investors ultimately pulls ahead? So let's look at the final tally. Ethan finishes with approximately $505,000 in total wealth, and that's factoring in both his property's equity and his net cash flow. Lucas finishes with $518,000. They reach nearly identical destinations. But you really have to look closely at the sacrifices. Lucas definitely contributed a bit more out-of-pocket cash over the years with those monthly additions, but Ethan invested hundreds of stressful hours and accepted massive concentration risk by betting it all on one single house.
But hey, before we just declare stocks the easy winner, we cannot ignore Lucas's risks. Achieving that compound growth required ironclad psychological fortitude. I mean, imagine opening your phone and watching your life savings plunge by nearly 40% in 2008 and then plummet another 30% in a matter of weeks during 2020. Lucas had to watch that happen and literally do absolutely nothing. Market volatility can be psychologically devastating if you aren't prepared for it.
So what's the takeaway here? The truth is, there is no single perfect investment. There's only the investment that aligns with your specific goals and your temperament. Ethan accepted concentration risk, and he heavily invested his time alongside his money to unlock the benefits of leverage. Lucas accepted extreme market volatility, and he invested his patience. So the next time someone fiercely insists to you that one asset class always beats the other, or that their way is the only way to build wealth, ask yourself one simple question. Did they include everything? Did they calculate the time, the stress, the hidden costs, and the psychological toll? Because as we've clearly seen today, the ultimate destination might be exactly the same, but the journey couldn't be more different. The real question is, which lifestyle do you actually want to build?